Okay, there we go. Well, let me start again. So welcome to our Life with Accident Health virtual study hall. Thank you for your time and attention and for being here. I know this is kind of a repeat from last time. And like I said before, one of the things that we're looking at is obviously we're going to expand the virtual study hall, given that we are now under shelter in place, I believe, toward the end of the month. I'm a bit unconnected from social media, not social media, but I am, it's kind of weird. My social media doesn't really go into what's going on in the main media. And so as far as the main media is concerned, I'm definitely unplugged from that. And so I just found out that they extended the shelter in place to the end of the month. And so we will obviously, we're going to extend all of our online programs and availability of these virtual webinars to our virtual study halls. We will continue to do them toward the end of the month with the goal specifically to prepare you for the exam starting May 1st. I know a lot of our students who were kind of caught in the classroom and then testing and then shelter in place during that time, you know, they weren't able to take their exam, and I know that they rescheduled for May 1st, which is cool because they got first dibs on those exam times. So with that being said, we will continue to review and cover the material that you should know specifically in the context to help you pass the exam the first time. That's our goal. Our goal is you pass the exam the first time, right? And so if you know of anyone, invite them, share this information with them. This is good for any state. It doesn't have to be California specific or California insurance licensing exam specific. You know, insurance concepts are constant. So regardless of where you're at, you can still benefit from learning the concepts. And yeah, the keywords might be a little different. However, again, concepts are constants, they never change, all right? So a quick recap of last week. Last week we talked about insurance, the insurance contract, we started that. We talked about the mechanism of insurance and all of the different terms that pertain to insurance. And if you want to go ahead and review that, you're welcome to visit our YouTube, and you can see that material that we previously covered. So let's get into the content. And like I said before, I'll teach for the next 30, 40 minutes. And then if you have any questions, please go and ask in the chat box, and I'll open it up to questions. But in the meanwhile, I'll just go through the material. I'll act as if I'm in the classroom. And so in order for you to get the most out of your time with me by watching this webinar, my suggestion is that you do what? I mean, if you saw the virtual introduction to study hall, what do you need to do to get the most out of this? You need to participate. So I encourage you to participate, whether you're in the room with someone else or on your own. If I ask a question, say it out loud, because like I said, the goal is to remember. And it's easy to remember, isn't it? When you review the material, because all that information is there. It's just a matter of how do I remember it for the exam. And one of the things that I want to remind you too is that a multiple choice exam is not a recall exam. So exams can be written one of two ways. Either they are written for the purpose of recall or recognition. A multiple choice exam is written for recognition, because see, you don't have to know everything. You just have to be able to recognize the right answer. And that's the goal. The goal is for you to be prepared so that you know the foundation and not overthink it, because, you know, taking an exam is a skill. I believe it's a skill, and you can learn the skills of test taking. And there's ways to get through the exam where it's not so daunting and so difficult and challenging. I can share, but I know first with certainty that the more you review, the more you retain. And it makes it easier to remember. So let's get started. And like I said, if you have any questions, then keep them to the end, and I'll be happy to answer them. And that way everybody can benefit from the questions, all right? All right, so let's start with a review here. And the review here is, see, the last time we chatted, we talked about insurance, the definition of an insurance policy. And I know this is much better writing than the last video recording. Insurance policy is defined as a contract whereby one undertakes to indemnify another against a contingent or unknown event. Now, again, this is, I mean, these are all of the keywords and all the key elements that you need to know that that defines an insurance contract, right? And so the key words, first of all, is that the insurance policy is a contract. And this is a review from last time, because review is always good. And then indemnify is the other keyword, right? So, you know, if you saw the last video, maybe you can recall what the keywords are. But the insurance policy is a contract. It is one that indemnifies another against a contingent or unknown event. And the things that we went over, or the concepts that pertain to the insurance policy, because the insurance policy is a contract, it's subject to contract law. And yeah, you need to know a little bit of contract law 101. And so in knowing a little bit of contract law 101, what does that include? What do you need to know about that? Well, first of all, there are 4 elements to a contract. So we say clickety-clack. What do we say? Clickety-clack, right? 4 elements of a contract. I'm going to do my best to make this small so that I can fit the other piece. Now, we say clack, C-L-A-C, clickety-clack, 4 elements of a contract. So what are they? What are the 4 elements of a contract? Well, we have consideration, right? Consideration is an exchange for value. Again, this is more review, so I'm not going to spend too much time on this. You need to have an agreement. An agreement is made up of both an offer and acceptance, right? So now this has to do with the contract, right? So with the insurance contract, who initiates the offer? Is it the insured or insurer? Now you have 50-50 chance, so which one is it? The insurer or insured? Now if you remember, the insured is the client, right? They may be the policy owner, but the person that's being protected. But for the purpose of the exam and for the classes and for these webinars, we will use the insured and policy owner synonymously. That's how they appear on the exam. However, you do need to know that the policy owner has policy ownership rights that the insured does not have. So there is a distinction. However, they may be the same person. So who initiates the offer? Well, if you haven't guessed yet, it's the insured. Now, the sales process is initiated by the insurer. However, the application filled out by the client, that is the inception, that begins, right? The process of the contract. So the client, the insured, fills out the application, pays you the first month's premium. That's part of the consideration. The agent, you accept the application, and then you forward it to the company to continue the underwriting. As the agent, let's put you, the agent, over here, right? As the agent, you are considered the field underwriter. What are you considered? The field underwriter, right? Field underwriter. So going back to our 4 elements include consideration, agreement, and what are the other 2? Legal purpose, and competent parties. Legal purpose and competent parties. Those are the 2 elements, or those are the 4 elements of a contract. So again, clickety-clack, 4 elements of a contract. And, you know, make sure that you understand these 2 separate, meaning the 4 elements of a contract and the 4 parts of the insurance policy. I didn't give myself enough room, so let's see if I can cram it in there, right? So the 4 parts, the acronym we use to help you remember for that is called DICE, right? DICE. See if I can make my dice there. Okay. D-I-C-E. So D for declarations, right? That's the who, what, where, when of the policy. Who's covered, for how long, for how much. Who's the insured, the insurer, the type of company that the insurer, how they're organized. You also have like the premium, all of those elements of the who, why, what, where of the contract, right? Who's covered. Now the insuring clause, that's also found on the deck page. And that's the insurer's promise to pay. That's their promise to pay, that in the event of a loss, they're going to pay out, right? As long as it meets the terms of the contract, of course. Then we have conditions. right? Of course, there's conditions. Certain conditions have to be met. For example, life insurance. What's a condition in order for the policy to be paid out? What the condition that has to be met is that the insured has to die, right? It's upon the death of the insured that the insurer promises to pay in exchange for the premium, a sum total amount of whatever the face amount is. The face amount is the amount of coverage that the client purchased. And then you have E for what? What is E for? Basically what the company will not do. Those are exclusions. Now there's some common exclusions. I'm going to go ahead and write in the life insurance contract. And there's an acronym we use, and that's WASH. Right? Common exclusions. Let me rewrite that so I have more with more space, right? WASH. These are the 4. War, right? What it is good for? Absolutely nothing, right? And then you have aviation. Well, it may not necessarily be an exclusion. It can be an exclusion. Some companies have limitations and exclusions on aviation, so you've got to find out for your company what those limitations or exclusions might include. Generally speaking, a person, if the insurer dies as a result of an accident, on a private passenger airplane, right? Like if you have a commercial flight regularly scheduled, that's going to be covered generally. But a private passenger airplane, right, that has more risk to it. So if there's more risk, then it's not necessarily going to be covered. The next exclusion is suicide. The suicide exclusion is basically, if the insured's death is a result of suicide, generally in the first 2 years, I've seen contracts that have like a 6-month suicide exclusion and a 1-year suicide exclusion. Generally, they usually have lower risk. They might, have a lower level of coverage. Generally speaking, the suicide exclusion is 2 years. So we usually say 2 years and a day. After 2 years and a day, go for it. That's supposed to be funny. All right. The next one is hazardous avocations or occupation. Hobbies, jobs, right? Hazardous jobs, occupation. Now, the reason why we cover these two side by side or together is because the 4 elements of a contract and the 4 parts of the insurance policy, we don't want to, I left that out, right? 4 parts of the insurance policy. Let me add that in there. We don't want to confuse the two because they may ask something like all of the following elements of a contract except. And if you remember CLAC has 2 C's in it, right? What are the 2 C's? Competent parties and what? Consideration. And if you notice, there's a C in DICE for the 4 parts of the insurance policy. So if they ask something like all of the following are elements of a contract except, then the exception is going to be conditions. The exception is going to be conditions if they're asking about the elements of a contract. See, in order to have a contract, you don't have to have conditions, right? It could be in exchange of a promise for a promise. I mean, you're both obligated to fulfill your part of the contract. But one of the things that makes the insurance contract is, as the policy owner, do I have to fulfill my part of the contract? Meaning, my part of the contract as the policy owner is to pay the premium, right? So this is what makes the insurance contract unique. So let's talk about the characteristics. I hope you can see the yellow. The characteristics, because this all belongs on the same sheet. Characteristics of the insurance contract. The insurance contract. This is what makes the insurance contract unique, is the fact that all of these characteristics exist at the same time. And so like I just said that, most contracts are bilateral. It's a promise for a promise. Unilateral contracts, however, is an exchange of an act for a promise. And that makes it unique, right? So let's put unilateral up here. Unilateral. Now, if we break down the word unilateral meaning one-sided. However, in contract law, and again, this is not a contract law class. These are just the basics that you need to know as defined in the educational objectives for the California Department of Insurance. And I'm going to go ahead and give the disclosure now. Like, all of this is education based. It's for you to get an introduction to insurance. I mean, overall, all of our programs in the insurance pre-licensing, they're designed based on the educational objectives dictated by the Department of Insurance. And, you know, we go a mile wide and an inch deep. And most people want to go like 5 miles wide, and then they want to go in like 20 inches deep. And that's just not the way. It's not designed for that. You know, if you want to go deeper into the learning and have more depth, that is going to come with experience, and that will also come with further education. The pre-licensing isn't the only class you're going to take. You know, in this industry, there's ongoing training that you have to take to keep up with changes that are going on in the industry. For example, I have a small independent health insurance agency, and so, you know, I have to keep up with open enrollment because I do individual plans. And so in the individual family plan market, open enrollment is being extended due to the, you know, COVID-19, and also because we have a state mandate. And I'll talk more about that when we talk about accident health insurance. So again, I'm always taking classes and, you know, keeping up with legislation that affect the insurance industry. So again, this is not, you want depth, you'll get depth when you gain more experience and you're in the business and you seek it too. I mean, part of it is I'm very curious by nature, and I love growth is my thing. So I love to learn. And so with that being said, there's a ton of programs out there and designations, and I'll talk about that separately. If you're interested in something like that and finding out how to get your designation or what am I talking about with regards to further education and taking other classes, unfortunately, we don't offer the designation classes, but I can certainly point you to the right direction for that. Just send me a message or make a comment, okay? So getting back to unilateral. Unilateral is one-sided. So it means that there's an exchange, right? In contract law, there's an exchange of an act for a promise. And there's an exchange of an act for a promise. And so most contracts are bilateral contracts. And if they're bilateral contracts, they're a promise for a promise, right? Insurance contracts are unilateral, is that it's an exchange of an act. Now check it out, an act for a promise. Now, if you remember from the first, if you go to our Facebook Live, or if you go to one of our first webinars, that I drew the mechanism of insurance where the insurer pays a premium to the insurer in exchange for that promise. And I emphasize the promise piece because this takes us back to connect the points on the characteristics of the insurance contract, right? Because the characteristics of the insurance contract include that promise and that act of paying a premium. Now, if the insured or policy owner does not pay their premium and fulfill on their act, so if they don't pay the premium, then that actually releases the insurer the obligation from having to fulfill on their promise. They don't have to fulfill on their promise if I'm not paying my premium, right? So there, again, in exchange of an act for a promise. Oh, let me go back. There we go. Apologize for that. So to go back and repeat, right? In exchange of an act for a promise, the insured pays their premium, insurer promises to pay. If the insured does not pay their premium, then the insurer does not have to fulfill on their promise. However, if I pay my premium and I have a valid contract, then the insurer, right, must fulfill on their promise, and they have to pay too, right? According to the terms of the contract, of course. So that's unilateral. Obligation is dependent on the other. What is it? The definition of unilateral, I gave you a ton of them, right? So I'm going to review the ones you need to know just to highlight them. Unilateral is an exchange of an act for a promise. Obligation depends on the other, and that's the key, obligation dependent on the other. And that, again, the obligation is the promise, and the promise is dependent on the other, meaning that the insured has to fulfill their portion of their act, which is to pay the premium. Another characteristic that makes the insurance contract unique is that these contracts are aleatory contracts. And there's two key words for aleatory, right? The two key words for aleatory are unequal, and uncertain, uncertainty. Now, why these two words, right? So aleatory is based on the nature of the insurance contract. If we go back to an unknown event, right? Against a contingent or unknown event or loss. I should add that in there, or loss. in the definition of the insurance policy, it's already defining this uncertainty. See, you're protecting against something that may or may not happen. The only thing that insurance will ensure that is certain to happen is what? What is it? Death, right? That is, I'm sorry to break the bad news to you, but yes, we're all going to die at some point. Maybe I shouldn't be joking around and given the COVID-19 right now. However, the nature of the product, right? The life insurance product is that it pays upon the death of the insured. And that is the only type of insurance that will protect against what is certain to happen. Everything else is uncertain. Even the surety bond, which guarantees performance, there's still an element of, well, actually that's to guarantee performance, right? Yeah, that's a bad example. I'm not a P&C person. So let's go back to uncertainty. And like, I don't know if I'm going to get in that car accident, right? Knock on wood. I don't know if I'm going to have a house fire or if my home's going to be burglarized. All of those things, everything is uncertain. You know, auto insurance, the car accident, like I mentioned, you know, commercial lines, product liability, all of those types of insurance, we're protecting against something that may or may not happen. But life insurance, everyone's going to die. And, you know, I don't know. I mean, the reason I say I don't know is because, like, if we were in a classroom setting, I would feel my way into the class and, like, I may share, for example, like, I believe everyone should have life insurance. Whether or not you have kids, whether or not you have dependents, it's the foundation of every sound financial plan has an element of life insurance. And if you have and we'll talk more about this in the life insurance policies, and I'm not trying to sell you anything. I'm just educating you in that even a small policy with cash value you will benefit from it. Excuse me. In that if something were to happen and you needed to borrow that cash value, you know, you can borrow the cash value and there's no credit check. You don't need to have a job. You don't even have to pay it back. So we will talk more about that. And this is kind of maybe a teaser for when we talk about the life insurance policies, right? And the policy provisions, because the cash value policies have policy provisions included in them. And those policy loan provisions they pretty much spell out like the terms of the loan and up to how much you can borrow. And if you don't pay it back, what happens? What are the effects on the contract? So again, we'll talk about that in another session, another webinar. But getting back to these characteristics of the insurance contract. Again, that's the uncertainty part, right? Now, the unequal part, I love this part. And, you know, I got into 3 car accidents in 1997. Now, unequal. Now, why am I underlining that? Because this is the point I want to make. In 1997, right? This is not on your test, but 1997, I got into 3 car accidents, right? My car was green. It was a cute little Jetta. And I hit another car. That was the first accident. It was in the rain, and I had just switched carriers. So I don't even remember how much premium I paid, but I paid my premium for 1 month. I just switched. My first accident, $11,000. $11,000. Now, was this one premium I paid enough to cover the $11,000 loss? Of course not, right? There we go. Unequal. There's an unequal exchange. I paid 1 month's premium and the company paid out $11,000. But see, that's the mechanism of insurance, right? That's how it works. If you go back to your notes from the first module, and I'm going to call the mechanism of insurance, I'm going to call that the first module. So if you go back to the first module and you go back to that picture will illustrate that, right? I paid my premium, and then the insurance company takes a portion of that premium and they put in the reserve account. And we all share in the risk. All of the other policyholders insured by that company helped cover the $11,000, right? The insurance company is the steward. They're basically the ones who manage the money. They collect the premium, and it's their job to be able to fulfill on their promise. And then the Department of Insurance regulates to make sure that they can fulfill on that promise. And, you know, and I'll go back and, you know, I'm very repetitious, very, very repetitious, but the benefit to you in that is that it will help you remember. It'll help you remember. So again, unequal uncertainty. The nature of the insurance contract is that you pay your premium, you're generally going to be covered. You know, as long as you didn't lie to the company, as long as you meet the underwriting guidelines, you know, because you still have to qualify for insurance. You just don't automatically get it. You know, some people think like, oh, I want to buy insurance. Well, sometimes you might be too old. You might not. One of the things that we say for life insurance is you buy life insurance with your health and you pay with your premium. And so there's a big distinction with that. Health insurance, you don't have to qualify because of the Affordable Care Act. However, you're still paying your premiums, right? The older you are, the higher the premiums. All of those principles still apply. So again, aleatory, unequal versus uncertainty. Unequal versus uncertainty. Let's see. So if you see aleatory, the keywords are unequal and uncertain. I'll give you one more quick example to remember aleatory, because I'm going to introduce another characteristic, and aleatory in this other word, I don't want to say it yet. Students for some reason I think because they both start with A's, can lead a little confusion, but I think if I say it often enough, at some point it's going to click for you, right? And in the clicking, it'll help you remember that aleatory means unequal or uncertain. So I had a student that I tutored. They didn't take the pre-licensing with us. They went through another school. This was many years ago. This was back in the mid to late 1990s. And I went up to Santa Rosa to tutor this student, and they'd failed the test a couple times. And then I went in, English was a second language. So, we went over some keywords and some mindset stuff to help them get over the fact that they didn't pass, a couple times before that. And so he goes on, he takes this exam and he passes, yay. And then his first client, he takes the premium application. 2 weeks after taking the premium and the application from the client dies in a car accident. Did the company did they pay the death benefit? Now, they had already done like the medical. Now in life insurance, they give what's called a conditional receipt. Had he still been alive, he would have been covered. He met the underwriting guidelines. So what do you think? Did they pay or not pay? They paid, right? Again, it's what other product will do that for you? The unexpected happens. He paid one premium, dies in a car accident, and then he has, a death benefit that's left behind to his family. So again, the nature of the contract is that there will be unequal. But see, on the other side of it is that, let's say auto insurance, right? I can't claim this because, as you know, I've already been in 3 accidents. In 1997, I got into 3 accidents, and thanks goodness, I've only been in one other since then. However, there are people who pay their premium and never, imagine like your homeowners, right? You pay your homeowners premium and never filed a claim. I live in San Jose. You pay your renters or homeowners insurance, you never file a claim, but all of those premiums that we're paying are helping to pay other people. It pays for their claims. So again, I love the definition of insurance that says insurance is a social device for spreading the loss among a large number of people, because it's the collective taking care of each other, facilitated through the insurance company. I know I keep saying that, but I'm telling you, I just think it's really cool. So aleatory, unilateral, the A word is adhesion. Adhesion. I don't know if I gave myself enough space to write it. So I'm going to put an arrow over here and then make some space for it. Yeah, I'm going to go ahead and erase this just to give myself more space. You'll remember wash, right? So adhesion. We define adhesion as, so the insurance contract is a contract of adhesion in that, I'm going to write a little thing over here that you need to know, right? What person, let me start with this. What person is capable, I think it goes like that. What person is capable of writing or making the insurance contract? Making insurance contract. Ooh, I'm not going to have any space here. Can you see it? Nope, it's cut off. But if you're listening, you'll know what I'm writing here. So, and it's a bit messy, but what person is capable of making the insurance contract? Well, the person that is capable of making the insurance contract is the insurer. They're going to give you options, and they might say like, oh, the agent, the broker, the client, or the insurer. The insurer is a person. They are a person. And they are the only person that's capable of making the insurance contract. They write the contract. There's no negotiating. You get to pick the amount of coverage, the type of coverage, who's covered, who's not, who the beneficiary is. Well, not covered, but the name insured is covered. But the insurance company writes the policy. And because the insurer writes the policy, if there's any ambiguity, so let me give you this definition first. Take it or leave it. They are take it or leave it because who writes the contract? The insurer. They're take it or leave it because the insurer writes the contract. And if there's any ambiguity is like a confusion. If there's any ambiguity or confusion in the writing of the contract, the courts will rule in favor of who? That's right. They're going to rule in favor of the insured because the insured had nothing to do with the writing of the contract. The insurer wrote the contract. So again, if there's any ambiguity in the wording of the contract, the courts will rule in favor of who? The insured. The insured. Let me go back and circle these words. Now, another characteristic of the insurance contract, and I'm running out of space here, right? I probably should have started another slide for this, but that's okay. We'll get it in there. Let's see. Let's use blue over here. So another element of another characteristic of the insurance contract is that these contracts are, give me a moment, they're based on utmost good faith. Utmost good faith. And there's a keyword that we use to help you remember utmost good faith, and that's rely upon. We have to be able to rely upon the statements made to be the truth. Like, I'm not going in to try to lie or deceive the company to get insurance. I mean, do people do that? Yeah, but for what purpose? Why would they do that? So they can get a lower premium, right? Maybe not even lower premium, maybe just qualify for coverage. But if you see a with good faith, just remember the nature of these products is that we have to be able to rely upon the statements made by both the company and the client that neither is trying to lie or deceive the other. Neither is trying to lie or deceive the other. And the other characteristic, again, that makes the insurance contract unique, I'm not going to write it down again. You see it in the other notes, but is that they are contracts of indemnity. This is the other characteristic right here, right? And because they're contracts of indemnity, what does indemnity mean? Do you remember? Do you remember, right? So indemnity is to make whole. What is it? To make whole. And I said there's multiple definitions for indemnity. You need to know them all. If you're not a California specific student or from California, maybe you're studying for an exam in another state, they might not use to make whole. They might actually use the full definition. We actually have been exposed to all definitions for indemnity because you might get the same question on your exam twice. We've had students even say they'll get like 3 similar questions. And so like in the test taker's mind, this is a test thing, right? In the test taker's mind, if they get the same question twice, sometimes what they do is they want to strategize and then they'll give it 2 different answers. And that makes sense if it's a smart test, but this is not a smart test. What that means to you is that it just accidentally gave you 2 of the same questions or 2 very similar questions. And so you want to stick with your first answer, right? Most oftentimes the first answer is the right answer. So to make whole and then to restore, right? That's that long definition. I don't have any space to write it down, but I'll go ahead and say it. And that is, the principle of indemnity is to restore to the condition enjoyed prior to the loss in whole or in part. So this is a really big piece here. I'm going to see if we have any questions. Nope, no questions so far. So, but if you have any questions, feel free to, I think there's an option there. If there isn't, then, message me at some point and let me know so I can open that up. But let's move on. So again, this is a snapshot. Like in the previous pages I gave you, or in the previous notes, I gave you some insurance, know the definition of the insurance policy, right? I'll put little stars next to the things that are testable items. So the insurance policy, you want to know it forwards and backwards. The insurance policy is a contract. And then the other one, they might say, another version of that is, according to the California Insurance Code, which of the following is considered a contract, right? So contract is the question, whereas the answer is the insurance policy. So there's 2 versions. So you want to know these two forwards and backwards, right? The insurance policy. You need obviously the 4 elements of a contract, the 4 parts of the, oh, see, you just need to know everything on this page. You need to know the definition of unilateral, aleatory, adhesion. Where's the other one? Utmost good faith, right? All of these key words to help you remember, right? In exchange of an act for a promise, one-sided, take it or leave it is adhesion. Aleatory, oh, here's a trick for aleatory. You want a trick for aleatory? Aleatory, we say this, Ali and Tori, right? They're sisters. So if you know sisters, think of sisters. Or maybe you have sisters or someone who has sisters. Ali and Tori are sisters, and they don't know, they fight, they bicker. Why do they bicker? Because one's going to get more than the other, and they don't know who. And that's the nature of the product, right? Is that we may benefit from the policy and have a claim paid, or we benefit from the policy still, but we don't get any claim paid. So we basically get nothing. But I don't like to say that we get nothing, because you're still getting the coverage, but nothing's getting paid out. And I think that's the thing with aleatory, is that either some people consider it a gamble, right? It is a nature. The nature of it is that there's a gamble, because you might pay like thousands and thousands of dollars of premium and then not get anything out, right? That makes it unequal. Or you might pay a small amount of premium and all of a sudden this huge claim gets paid out. You know, one of the things that I like to emphasize in life insurance is that if I buy $1 million life insurance policy, will my premiums equal $1 million? No, never. By the nature of the product, it's unequal. So my premiums will not equal $1 million face amount. I mean, why would you buy it if it's going to total $1 million, right? Let's see. So we have a bit more time. I'm going to add this other piece, again, following the insurance contract, right? And that is, can you buy, so let's say the policy owner, right? So let's say you are the policy owner. Policy owner. And then let's put me over here. I like green. Green's one of my favorite colors. So I'm the insured. Or maybe like person or thing, right? So the thing would be what? In this example, it would be a car, right? I'm not obviously doing, this is as good as my pictures get. They don't get any better than that. Or maybe a house, right? Or like, I like to refer to the business as the money machine. Oh, this is not a very good house. It looks like a commercial building. Let's put some grass around it. Okay, there we go. And then the money machine is the business. So, and this represents, right? Life insurance, auto insurance, homeowners insurance. Here, let's put auto, homeowners, and then the money machine is the business, right? So in order for the policy owner, and I'm not going to make the distinction for the P&C, property and casualty, but in life insurance, basically, because usually the insured, right, is the person who's being protected. They're the ones who's paying the premium. And again, they're the same person, right? I think that's why they're used synonymously, because in property and casualty insurance, because this does pertain to both, they have the first named insured, and the first named insured is the person who gets all the notices, and they're responsible for the premium and so on. So, but in this example, the policy owner, you're the policy owner, and I'm the insured. Can you buy a policy on my life? Can you buy a policy on my life, auto insurance, on my car, homeowners, you know, on my home, or insurance on my business? Can you buy that for me? And is it yes or no? You got a 50-50 chance. Life insurance, all of those, no, you cannot buy insurance, because you don't have this relationship with me. I mean, okay, maybe we have this student-teacher relationship maybe, and if I died, you could care less, but maybe from a humanities standpoint, you might be like, oh, I que lástima she died, right? Or, but really there's no economic loss or effect if I were to pass, right? There's no connection there. And there has to be a relationship between the policy owner and the insured of love, blood, or money, 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 right? And this relationship is called an insurable interest. In order to buy a policy on person or thing, what's required? There has to be an insurable interest between the policy owner and the insured of blood, love, or money. So blood would be like family, you know, family. Let me change the color here. Oops, I'm sorry. That's blood is family. Blood, I said it backwards. Actually, I'm going to switch them around because of the way I say it. So blood, I don't know how I did that. Love or money. So family, right? Immediate family. Well, even like I can buy a policy on my niece or nephew. But of course, if you're going to buy a policy on someone who's 15 and a half or older, a life insurance policy, you have to get their permission. They actually have to sign as the insured. So if you're married and you want to buy a policy on your spouse, then you're welcome to do that. You just have to get this, because that would fall under blood, right? So spouses. So that would fall under love, and they'd have to sign as the insured, giving permission, because you have to remember in the life insurance policy, they're going to ask for medical information, and that information is private information. So you're going to sign up on the application, giving the insurance company permission to gather all of that personal health information. And then money. What is money? Money is business, in business situations. This is one of my favorites. So let's say that, so because there's personal use, this is personal, right? There are personal uses, and then, let me fix that there. There's a personal use and business uses to life insurance. And for those of you who are on the employee benefits world, right, you're applying insurance, life insurance and health insurance as an employee benefit, which is a business use of life insurance and health insurance, right? So there's a couple reasons that you would use life insurance for business. And one of them is, or health insurance, right? Employee benefits. And then the other one is for succession planning and funding. Succession planning and funding. So if we have two partners up here, let's say on our money machine, I'm a huge fan of pastries. So let's say that we have, AJ Patisserie, La Patisserie. And AJ represents two partners, Patisserie. And we have, we have Antonio and James. These two guys are business partners. And so, if one of them were to die, what would happen to the business in this partnership? So if one of the partners were to die, the business would die with that partner, right? The partnership is dissolved on the death of the partnership. So we have AJ Patisserie. One of the ways to protect the business and protect the other survivors of the deceased partner. So let's say Antonio's married, right? We'll say the wifey's over here. And then we'll say James is married and the hubby's over here. Yes, I'm in San Francisco, so keep an open mind. And I'm not in San Francisco, I'm in San Jose, but I am in the Bay Area. So, I want to keep it open, right? To allow for everyone to feel accepted. So I don't know why I feel like I have to qualify that statement, but I am. So we have wifey over here and we have hubby over here. And so if we don't have a plan in place and Antonio dies, his wife wouldn't have any claim to the business, right? The partnership would dissolve and there would be no right. So, and again, I'm not an attorney, I'm not giving business advice, but one of the common uses of life insurance for business is not just the employee benefits, but let's say that Antonio and James put together a buy-sell agreement. And the buy-sell agreement is a contract and it's written by an attorney. So you as an agent, obviously you're not going to write it unless you're an attorney. And the buy-sell agreement, they're both agreeing. So Antonio and James they're agreeing in advance that if they were to die, oh no, pobrecito, if he were to die, guess what? That he agrees to sell his interest to James and James agrees to buy the interest from Antonio upon his death. Therefore settling, right, with the surviving spouse in this situation with the wifey. So again, you don't write the contract, but you're probably wondering, well, then why are we covering this, right? The buy-sell agreement is a contract. what your role as the agent and employee benefits people, if you're listening to this, you're not going to do this. This is what the life agent does. The employee benefits usually support staff or their, account execs, or they're out there, getting the business and writing the group business. Yeah, that's what you do. You write group insurance, group plans. But you also have individuals out there that help small businesses with succession planning and with funding. And if you have a closely held corporation, or even, any corporation, or if you have a partnership, it's a good idea to put a buy-sell agreement together so that upon the death of one of the owners, that there's a plan in place to continue for the funding of the business. So in this situation, what you would buy is life insurance. Life insurance would be the means to fund the buy-sell agreement, right? Because boom, upon the death of the owner or one of the owners, the partner, then the life insurance policy pays, settling with the survivor, and then also offering the monies and the funding to keep the business going. Because if one of the partners were to die, what happens to the business? Well, one, the value of the business goes down. And two, you just lost the expertise of that owner. And so, here we have over here, James is like in a question mark because he says, oh no, I lost my business partner. What do I do now? And instead of taking assets of the company to try to keep it afloat and keep it going, life insurance, is in place to kind of save the day, right? Settle with the survivor and then to continue perpetuating the business, right? So then now we have like J patisserie. Now, let's say that, James continues on. He's, he owns the business. He gets another owner. He gets another partner. Can he do another buy-sell agreement? Absolutely, because he just signed on another owner, right? Now, let's go back to Antonio and James. Can we do that? Let's go back to Antonio and James. They're both still alive. Antonio and James, they're both still alive. Let's go back and let's take this out. But guess what? Ooh, now we have Michaela comes into the mix. Now, Michaela, she has this spice. Like she brings, because remember, they're a patisserie, right? They make these delicious little, fluffiness of everything. But she comes in and she has these little round, they look like donuts, but they're not. And they have caramelized sugar on them and they're so delicious. And they stuff them with like chocolate. And you know what? She has her little special herb of, she uses powdered vanilla. But see, these two guys, Antonio and James, didn't figure out the powdered vanilla. They use vanilla extract, which evaporates when it's cooked. But she comes in and all of a sudden sales go up. And she, becomes an intricate part of the business with her little recipe with her pastries. And they're selling all over the San Francisco Bay Area. Guess what? She now accounts for about 30% of, and I'm qualifying her value. Why am I qualifying her value? Because if something were to happen to Michaela, guess what? That would have an economic effect on the business. So one of the ways for the company to protect against that is that they could buy a key person life insurance. What could they buy? Key person, right? Key person is designed to indemnify. It indemnifies who? It indemnifies the business. So key person, indemnify the business, meaning it protects the business if this key person were to die. So again, business uses in the succession planning for life insurance, we've got two. The buy-sell agreement, where they can buy life insurance and they can buy life insurance on each other, right? And this is what I'm getting back to, the insurable interest. Is that Antonio and James, because they're business partners, this is the business piece, they're able to buy life insurance on each other. And we can go into more details about all of that. But I can count on like reading you can review. I wouldn't go into too much detail. They don't ask a lot of in-depth questions about this. This is more of an advanced planning type of tool. You're not going to go into the business uses of life insurance and go put, fund buy-sell agreements and key person unless a situation arises. Usually in the life insurance world, you start off in the personal lines and then you grow into the personal uses, and then you grow into the business uses of succession planning and funding, right? That's more advanced planning. But just to recap real quick, the key person indemnifies the business. It protects the business in the event that the key person dies, right? Because remember, Antonio and James, the patisserie, the AJ patisserie, they have patisserie shops all over the Bay Area. So they have employees that rely on them. So, protecting the business in the case in case of the death of the key person, then they are able to meet their financial obligations to continue caring for the people in their business, right? All right. So I'm going to wrap it up here. Wow, I didn't realize how far I've gone. Last point here. This is really important. Well, everything I say is important. Well, not really, but you know what I mean. So the insurable interest, if we were in the classroom, I'd say, put your hands up in the air and go like, woo, woo, like raising the roof type of thing. And visualizing when you're making that motion of raising the roof, right? The insurable interest, as you're pushing your hands up, the insurable interest supports, it goes back to the principle of indemnity. Woo-woo, right? So again, you're going to think I'm crazy, but the reason I do that is when you go to your exam, and I get feedback like this from my students, is like they remember things that I said, or actions that I did, or actions that they did in the class. Because remember, we want to incorporate all learning styles: visual, auditory, and kinesthetic. So when we raise the roof and put our hands up in the air and we say insurable interest, woo-hoo, principle of indemnity, it's going to help you remember. Another way, some people don't like the whole kinesthetic piece, and then I'll say, okay, visually check this out. Insurable interest, I. See, the insurable interest supports the principle of indemnity. Well, what does that mean? Well, we know that the principle of indemnity means to restore, right? To restore to the condition enjoyed prior to loss, in whole or part. And I talked about this in another section, in another webinar, to in whole or part. And I say in whole or part because you're only going to get what you pay for, right? Now, the reason this is important is, see, without the insurable interest, you could go out and buy insurance on anyone. Then, we have our friend here who'd say, oh, well, then let's go to the nearest senior home and see who's close, who's still eligible for coverage but close to dying, right? That's what would happen without the insurable interest. You can't buy insurance on anyone or anything unless you have that economic type of effect on you, right? The loss of a spouse, even the loss of a child, even though the child doesn't have like economic income coming in, money coming into the household. If you were to lose it, I hate saying this, but if you were to lose a child, that you wouldn't want to go to work. You don't want the opportunity and the time to recover from that, right? That's a loss. And so if you don't want to go back to work, then there's a loss of income with that as well. So again, the insurable interest, without the insurable interest, we'd be shopping around trying to figure out, who's a high risk and go buy insurance on them. So no, you cannot do that, right? That's why the insurable interest supports the principle of indemnity, because here's the big piece. I'll put it in, let's do it in black over here. No chance for gain. Right? No chance for gain. See, without the insurable interest, then there would be gain. But because of the insurable interest, or rather, and because of the insurable interest, not a but, and because of the insurable interest, there is no gain. Insurance isn't about gain. It's about protection. It's getting back to where you were before you suffered the loss. So this will complete this session of the contract law, and like what's required to get insurance to buy insurance on person or thing is you need to have that insurable interest requirement met, right? Real quick, for life insurance, you only have to meet the insurable interest requirement one time. So I always say one life to live one time, meaning that let's say that Antonio and James, they buy policies on each other when they're in business with each other. But let's say they dissolve the business and I don't know, for some reason they have it in their head, we should buy policies on each other. Well, at that point, they're no longer business partners, so there's no longer that insurable interest, right? Because that money thing is no longer there. Now, let's say that, I know I'm going to go out on a limb here, let's just pretend that Antonio and James, they're not business partners, right? But they are married. Do they have an insurable interest on each other? Absolutely, because now that becomes love. They're married. And then they have kids, they adopt children. So if they adopt kids, yes, that's not blood, but it's still family, right? So, and it only has to be one time. So let's say Antonio and James, they end up,
divorcing. If they divorce, guess what? The policy is still a valid contract because the insurable interest only had to be demonstrated once. And one time, and that's at the time of inception. When? At the time of inception. I know I'm keeping it a little bit longer. Just give me 5 more minutes. I did start 5 minutes late. And then property and casualty. 2 times, 2 times. What is it? 2 times, 2 times. At the inception, meaning at the beginning, and at the time of loss. So for property and casualty, it has to be at the beginning and the time of loss. So there has to be insurable interest 2 times for property and casualty. So I needed to highlight that because that goes, right? This goes with insurable interest. So here we go. Principle of indemnity, insurable interest. I'm going to use this piece here that you need to know that the insurable interest exists at the time of inception, at the beginning. In order to buy insurance on person or thing, right? That insurable interest is required. And I added some elements here on the business uses of life insurance. You know, I'm very conversational in what I teach, and I feel that, you know, this is a good place to talk about this money machine piece, like the business uses of insurance. And I don't usually go back on it because, like I said, this is more of an advanced planning. This is more advanced planning, meaning, you know, you have more experience in the business when you start doing these types of plans. And so I just touch on them because you should be introduced to them and you need to know them for your exam. Like, you do need to know about the key person for sure. Make sure you know the definition for that. And, you know, if you purchased our students will have the playbook. I think all of our students, I think from this point forward, while shelter in place is, we're not requiring it, but we're encouraging that you have the playbook. And there's sample questions and answers in your playbook pertaining to that. I will do a session on how to study the playbook probably at the end of this week because we do have a specific style on how to study the playbook. I'm going to open it up for questions. Do you have any? I'm going to see if there's any questions in the queue. There are no questions in the queue. I want to thank you for your time and attention. I hope you found this beneficial. And I look forward to our next session. We do have a session this afternoon at 2:30. And I'm not sure if we're going to continue the conversation or if we're just going to repeat. I will post it on our Facebook page in the next hour. I know we're still working on the planning for property and casualty and the plan for the life and health as well, as far as like I'm going to have other teachers. I'm going to open it up to other teachers who may want to also teach segments of this class. So I'll know more later this afternoon, but otherwise, just as a recap, Monday, Wednesday, Friday, twice a day, 10 and 2:30, and then we'll know a little bit. Again, we're adjusting and continuing, right? I mean, there's a lot of uncertainty, but certainty. And the uncertainty is like, okay, what's next? That's the uncertainty, right? But the certainty is that we're going to get ahead of this at some point. We all will, and this will end, and yet be the same. We will never have the world we had before all this. And yet, you know, we just keep an optimistic outlook. So stay healthy, be optimistic, and I look forward to our next webinar. All right, take care. Thank you.